Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about the top ETFs that I'd be looking at right now if I could go back and relive my 20s, 30s, and 40s. We're talking about growth and volatility and no fear to come along with it. Simply easy investing with ETFs. So if that is what you're looking for, please stick around. So in case you're not familiar, ETFs are a basket of stocks, and that's great for retail investors like you and I, whether we're young or old, because it offers us diversification. We can still target growth if we're young, but we get the diversification within this individual fund. Now, if I was young, what would I be looking for in these ETFs? Well, a couple things. 1, growth. 2, quality. 3, volatility. It's actually our friend, right? Right now, everybody's talking about a recession. If we do have a recession, well, you've seen all the effects already, right? Amazon, Alphabet, Microsoft, they're all laying off people. That part's bad. The good part as a young person with a long-term view in the stock market is if a recession forces our stock market to go down for 1, 2, 3, 4, 5 years, we're okay with that, right? Because we're going to be able to dollar cost average in at those lower prices over a long period of time, build up our portfolio, and then it'll be glorious as we head up and to the right when we have that next big bull run. So that's perfect for us. And finally, income. We want to avoid income. We don't want ETFs that produce a bunch of income that make us pay a bunch of tax. We want these ETFs that keep those in those individual stocks. We want those stocks to grow, right? We want them to use that income for growth. So don't receive the income, keep it in there, grow it. You don't need it right now. You'll need it later. So grow now, push it off for a later date. So let's take a look now at a couple different ETFs that might offer this kind of setup. So there are lots of great ETF products out there. I want to show you what I'd be looking for as I go through this, especially through the eyes of a young person. So what am I looking for when I say, oh, I want growth, I want volatility, but I don't want income? So in this case, I'm looking at VGT. And at the end, I'm going to summarize all this information too and also show you some alternatives to these particular products. Now, this is Vanguard, and I do like a lot of Vanguard products. I'm not a Vanguard rep, but we'll show you alternatives at the end as well. But this is the information technology ETF from Vanguard. Now, one of the first things that I always look at is the expense ratio, and this one's 0.1%. Not bad at all. That means for every $10,000 you invest, they're going to take $10 out of your account to pay all the people in the office over the course of a year. You won't feel it at all. So 0.1%, perfect, right? 1%, unacceptable. Something that high, unacceptable. Just cross it off the list. You shouldn't be paying that much. You can get an actual real financial advisor to take you on versus 1%, right? So I'm looking for 0.1, maybe 0.5%'s okay, but something underneath there. It can go to me a little bit higher depending on what they actually do, how much it's managed. But one of the reasons I like Vanguard is a lot of them do have these low expense ratios. So this particular one does have a small yield. Again, we don't want to receive that income, but 0.8%, we're not going to get too much. Again, put that back into those stocks, have them grow. That's what we want. It's got $40 billion in assets. So you see the chart too, unimpressive. 2022, a lot of growth funds, you're going to see the exact same thing. 2022 wasn't a great year, but that means on these dips, you got to buy at a lower price. So not too bad of a deal, right? Now let's look at what is actually in this fund, and you're going to see the top two holdings, Apple and Microsoft, are nearly 40% of the fund, 20% and 18%. Then you got NVIDIA, Visa, MasterCard, Broadcom, Cisco, Accenture, Adobe, Texas Instruments, all right, and that rounds that out. Now altogether, they got 371 different stocks in this, but definitely concentrated in Apple and Microsoft. Now, if I'm a young person, I'm okay with that because I still believe there's a lot of growth to go on in Apple and Microsoft. So I'm okay with that. Does that mean I put 100% into this particular ETF? No, but this is a nice growth fund that I would be looking at. Again, 89% of it is technology, so that is going to be focused on growth. Now, this is a comparison of VGT versus some of its peers, as shown on Seeking Alpha. By the way, I am a Seeking Alpha affiliate. I'm supposed to mention that. There are Seeking Alpha affiliate links down below if you like what you see here. A lot of this information comes from Seeking Alpha, but that's down below. If you find benefit from it, have at it. If not, ignore. Now, you can see versus all of these peers, VGT over a 5-year period has still come out ahead slightly at nearly 90% return. So this includes the pandemic. This includes 2022. Still doing pretty darn well over the last 5 years. So do you have 5 years? 90%. Guaranteed. Okay, I can't guarantee anything, but you can see the pattern over a long period of time. And we had a nice, beautiful 10-year bull run. So part of that is included in this. So keep that in mind. But compared to some of these other peers, pretty darn good. And you can kind of see the expense ratio and how that varies from product to product as well, with VGT having one of the lowest on here. Now, last slide I want to show you for VGT is a comparison of it versus some other popular ETFs, and we'll talk about these as well. So this is a comparison chart over a 10-year period, which would include a lot of that bull market, of VGT versus VOO, which is the S&P 500. We're going to talk about that in a second. VUG, which is another ETF that I really like from Vanguard, and QQQ. So you can kind of see the comparison. Again, over a long period of time, over a 10-year period, VGT has outperformed all of them, with QQQ coming in second, VUG in third, and VOO, the S&P 500, pulling up the rear, but still at a very solid 164% return over a 10-year period. So that's my first one, VGT, that I'd be putting a portion of my money into if I was a young person. So the next one that I want to touch on rather quickly here is VOO, again from Vanguard. This is the S&P 500 ETF, and there's plenty of alternatives to this one. But whether you're in your 20s, 30s, 40s, or 50s, I think you can be putting money into VOO and betting on our market over the long term. Now there's another comparable product, VTI, that gives you exposure to small and mid cap. But if you look at a 10-year chart, VOO is actually outperformed. That's why I always say I'm going to go with VOO. Although in an M1 account, I do buy VTI as well. But very similar. Now, expense ratio on this one's extremely low, 0.03%. It does have a quarterly dividend, pays out about 1.6% at the current rate. So you are going to get a little bit more income, but that's okay. Now, it is a very large fund, $272 billion in assets. It's one of the big boys. Now, let's look at what it actually holds in there. And again, you're going to see similar, but more balance in this one. So again, maybe a combination of the first two that we talked about. At your discretion and how you want to balance those two. But again, you're going to double up on Apple and Microsoft again right at the top here. But this one has just over 500 different stocks in there. It is the S&P 500 Index ETF, and it's pretty well balanced, but still a lean toward technology, healthcare, financials. So you also have Amazon, Berkshire, Alphabet, United Health, Alphabet Class C, Johnson & Johnson, Exxon, and JP Morgan to round out the top 10. So again, a little bit different exposure, not quite the growth, but a good solid ETF. And just to show you here, this is a 10-year chart. Again, it's returned about 220%. This is the total return that we're looking at. And overlapped in blue, just so you understand, is the S&P 500 index. So it mirrors that index. You can see how well it does mirror that index. So that's VOO, Vanguard, S&P 500 ETF. The next one that I picked out is SCHD. This is the Schwab U.S. Dividend Equity ETF. Ever so popular, and I think this is a great one whether you're in your 20s, 30s, 40s, 50s, maybe even 60s. Now, this one does provide a little bit more income. So again, it's about balance. How do you want to balance out your portfolio? And let me tell you right now, this isn't like a complete portfolio. These are just some, I think, very good products for those that want to invest in the stock market over the long term. Now, this particular one has the objective of tracking the total return of the Dow Jones U.S. Dividend 100 Index. So one of the things I like the most about SCHD is its strategy, and it's laid out very nicely here. But it focuses on 4 factors, right? And those are cash flow to debt, return on equity, dividend yield, and 5-year dividend growth rate. So maybe this is one that when you're young in your 20s, you just have 5% or 0%, however you want to do it. But as each decade rolls past, maybe you increase that percentage to turn that income up a little bit until you get it to a point where, SCHD is providing some of the income that you want as you approach retirement. It's really up to you, but I do like their selection criteria for picking individual stocks that go into this fund. So this is another ETF with a very low expense ratio, which I love, 0.06%. Does have that higher yield of 3.37%. It's got about $45 billion of assets under management. So growing fund that more and more people talk about every single day. Now, what's actually the makeup of this? And this one will change based on the criteria that we talked about. But you can see, very well balanced. Highest one is 4%, 4.44%. That's Broadcom. Then we got Verizon, Merck, Texas Instruments, the Home Depot, Cisco Systems, BlackRock, IBM, Coke, and Pepsi. And you can kind of see financials are the top one here, industrials, technology. Again, balance throughout this fund, focused on that different selection criteria. Now, if we compare this to peers, again, here's the one that come through Seeking Alpha. You can see quite a few that I also like that are in this list. VYM, I'm a shareholder, right? I own shares of VYM. But you can see over a 5-year period, again, SCHD is best in class compared to its peers that you see here. And again, those expense ratios, again, this one kind of shines at 0.06%. And this is a chart of SCHD versus the S&P 500 over a 10-year period, measuring the total return of both of these. And you can see that in 2022, SCHD shined just a little bit with its selection criteria and outpaced the S&P 500. And finally, I decided to include VEA, the Vanguard Developed Markets ETF. A little bit of a curveball, but being an American, sometimes we forget about the rest of the world. And it should be a component as we build out a portfolio. So the return on this is not going to be great. It's one of the better performers in this area. Again, it's developed markets. We should look at emerging markets and consider other things as well. So it could be a very small component, but it's something to think about. So I wanted to take a look at VEA. Now this one has a 0.05% expense ratio, pays about 2.7% in yield. It's got $108 billion in assets. And again, performance wasn't great last year, but it wasn't horrible, right, over a one-year period. Now, if we look and see what's in here, well, it's got a whopping 4,091 different holdings within this fund. Some you will have heard of, some of them you'll probably scratch your head. Number one is Nestle. Hey, I know what that is. You'll see other things down here like Samsung and Toyota Corp down at the bottom. So there's going to be some here. As far as balance, financials, industrials, healthcare lead the way. Consumer cyclical follows it up. So not a bad way to look at it. Now, if I go over to VEA versus a few other products, the S&P 500, for example, VXUS, IXUS, and VWO, which are some other emerging market and total world ETFs, you're going to kind of see the performance of the S&P 500 over a 10-year period really kicking its butt. And that's why we want to focus on growth. We want to consider what could happen in the United States over the next 10 years as well. So you can kind of see VEA and where it sits compared to some of these other ones on this chart. So just a consideration. Now, let's summarize all these together. So here are those four all nicely summarized, but this is not a complete portfolio build. What I would focus on if I was young is to be in growth mode, like I've got listed there. I'd focus on things like VGT and maybe the alternatives that are up there as well, like VUG or QQQ, with a focus or emphasis on keeping that expense ratio low and not receiving too much income. Because we can see if we shift all the way across to that 10-year return, I want that 434% over a 10-year period, right? And I'll balance that out with some of these other ones too, like VOO or SCHD or VEA. 220% for VOO, 243% for SCHD, and 67% for VEA, which we can call toilet paper because it's wiping up the rear. But it's the rest of the world. We have to consider that. So that's why it's in there. So not a bad place to start. And down here at the bottom, I've got the average distribution yield of about 2.17%. So you will receive some income off of this in the form of dividend payments. But that's not the goal, right? This is growth mode. So again, focus on those growth ETFs. So a couple of things. First of all, I am a Seeking Alpha affiliate. There's an affiliate link down in the description. If you like what you saw here, feel free to sign up. If not, ignore it completely. Second, if you wouldn't mind, please like and subscribe to the channel if you found any of this information beneficial. And third, I want you to have a great night. I really appreciate you watching. Take care. Whoop.